I'm Jonathan Davis, if you didn't know, and this is Simon Elliott.
Hello.
And we had the good fortune to start our podcast exactly 5 years ago next week. And so we're coming up to the 5th anniversary. Well, it's just continued to grow over all that time. Specializing in talking about investment trusts. Simon's moved on to a much better paid job. He wasn't paid at all when he did the podcast. We're here to talk about what's going on in the investment trust world. And I'm going to give you very quick bullet points, and then we're going to talk about each aspect of that. So first of all, dramatic changes to the world order. You've heard Jim Mellon on this subject. Donald Trump is tearing up the global order. It's going to have a lot of implications for all of us. Investment trusts have been through their own mini crisis over the last 2-3 years. We've seen massive selling, we've seen wider discounts, but a lot of volatility. We've seen Saba Capital, this activist US investor, come along, buy lots of stakes, try to get some change. Cost disclosure, an issue about regulation, very tedious subject, regulation, but it has had an impact on investment trusts. What's happening there? Consolidation, we've had lots of mergers last year. We've had investment trusts winding up, and so on. Is that going to continue? And finally, are those discounts I mentioned, are they creating opportunities for you and I to make some money? So this is a picture of us. You don't need to look at that anymore. It just describes that we've been doing the podcast for 5 years. I also produced the Investment Trust Handbook, which you may have seen around the place, and you can pick up a copy later if you're interested.
There we go.
There it is. Okay. Full of information. Comes out once a year. We're into our 9th year this year. And we won awards from the AAC last year. So, very quickly, what's been happening in investment trusts? This chart shows you the performance of all the investment trusts in the FTSE All-Share Index. And it's comparing that to the performance of gilts, i.e. the government bond yields, what their interest rates are. This is a price performance. It's the inverse of the yield. So when the yield goes down, the price goes up. When the yields go up, the price goes down, so on. So there's been this big derating, and you can see how this happened, like that. And now, are they on the way back? Investment trusts are on the way back. So, Simon, where shall we start? We'll come back to that one, I think. Where should we start? Let's just quickly talk about the markets overall and how that is going to impact, or has impacted and is going to impact what's happening in the investment trust sector.
Yeah, so, well, good afternoon, everybody. I hope you're all enjoying the Master Investor show. I mean, I think as Jonathan said, it's been an incredible year for investors in investment trusts. I think if we stood here 12 months ago, it would have been difficult to have predicted all the things that have happened in that period of time. I mean, just looking year to date, the performance of the US market, for instance, we're probably down about, in sterling terms, 6, 7, 8%. Conversely, the UK market, which has been a laggard for a period of time, is actually in positive territory, up about 6%. Europe's doing even better. Europe's really enjoying a good run at the moment. And we're seeing markets like China having a very good pop as well. I don't know if either of us would have been quite brave enough to predict all those things this time last year. And I think it probably leads to the argument that it does pay to be diversified. To have a diversified approach to investment, I think, does make sense because it's very, very difficult to predict these things.
It is fair to say, Simon, that at the end of 2021, he gave a talk at the AIC, which is the industry trade body, and he said to investment trust investors, you've never had it so good because of all the things that were going well for investment trusts. That was very timely. If you've taken notice of that, you would have saved yourself quite a lot of money, basically. So where do you think we are now in the cycle, Simon? Have we got through this phase of correction, which has been characterized by some declines in performance in number of trusts, particularly alternatives, but also these widening discounts?
Yeah, so I think the key word on investors' lips at the moment is uncertainty. I think the Trump administration has obviously led to a step change in policies. What's going on in terms of tariffs, what's going on in terms of the immigration policy, and what does that mean to the US market? And my colleague, Katie McGee, is speaking on the main stage after this event, and frankly, she's got a much better insight into it than I do. but it's all about uncertainty. I think it makes it quite difficult for investors to make decisions in the short term, and that's why I think it's important to take that longer term view where we are at the moment and look through some of the noise that we're undoubtedly seeing in the markets at the moment.
And there has been some exceptional volatility in the investment trust sector, not just overall with these declines that we saw, but also between individual trusts. Been an extraordinarily wide dispersion of results, which I can illustrate just by showing you what's happened since this time last year when we spoke at the Master Investor Show last year. Okay, what's happened? Well, these are some of the investment trusts that have done well, and you can see a lot of them up by more than nearly 50% or more in some cases. Now, some of that's done from inherent performance, others from discount narrowing, and in some cases by corporate activity. So something like, let's pick out, what have we seen?
Hipgnosis.
Hipgnosis songs, famously, of which we used to talk about a lot on the podcast.
Yeah.
Unfortunately, no longer with us, so we can't compare notes about our musical tastes anymore. But that was taken out after some a very timely intervention by some UK investment trust specialists. We've got something like 3i, which continues to astonish everybody by performing so well. So a mixture. So those are the good ones. And then we've had some shockers as well. Fortunately, we've got rid of the really, really dodgy stuff that came to the market just before the peak in the investment trust sector. So we've said goodbye to things like Home REIT, which is a scandalous situation, and others. But there's still quite a lot of recently launched trusts which have performed very poorly. And some people think there may be opportunities here because they perform so badly. But we'll have to wait and see about that. Digital 9 has been takes the honor for the worst performer since last year. A lot of people thought it was must be cheap because it's trading at a 60% discount. Well, it's still very cheap, and in fact got cheaper. So had too much debt, messed itself up.
So just before you jump on, Jonathan, I should point out there are no JP Morgan trusts on the best performers, but equally there are no JP Morgan trusts on the worst performers, so I take some solace from that. But I think one of the themes that you do see here is on the renewable infrastructure side, so energy infrastructure, and that has been a very difficult area of the marketplace. Clearly, there is some correlation between energy prices and how those particular trusts have done, and the fact that yield codes, so those companies offering quite attractive yields, are really been out of favor at the moment as the gilt prices have normalized.
So what we can say, though, I mentioned earlier that we were talking about the relationship between interest rates and investment trust performance is particularly close with all the alternatives, so renewable energy, private equity, commercial property, and so on. And what we've seen since last year, we've seen some movement in interest rates, obviously, but not as much as people were hoping for. It looks like they're going to stay higher for longer. So that may continue to be a drag. But there's a big distinction between equity trusts, like the ones that JP Morgan offers, and alternatives. Perhaps you might just explain how they've diverged in performance this year.
Yeah, so I think that's a fair point. So as you say, JP Morgan, we have 16 investment trusts. 15 of the 16 are invested in what we call long-only equity funds. So you may have heard Guy Anderson talk about Mercantile earlier on. We've got the JP Morgan American Fund coming up just after this. And these are portfolios of stocks, companies that you will recognize. And you can almost describe them as kind of plain vanilla investment trusts. They've been around a long time, often in some cases over 150 years. So F&C Investment Trust is on stage later on, 155 years, something of that ilk. But as Jonathan said, there was a wave of alternative funds, so alternative investment companies that were launched post the GFC. They were, in many cases, bought as bond proxies. They're not bond proxies, but they are very interesting underlying asset classes. So renewable infrastructure would be a case in point, or music royalty funds as well, which is sadly no longer with us. So these are those type of companies are the ones that have struggled as interest rates have normalized. So if interest rates have gone back to the kind of levels that we'd expect or saw before the GFC, so those investment companies have derated, and they're the ones on big discounts at the moment.
That's right. So while the average average equity trust trading somewhere
15,
between
16?
Yeah, exactly.
Oh, and long-only equity probably around 10.
Yeah, less than 10 in most cases.
Yeah.
But in alternatives, some of them still on 30, 40, 50% discounts.
Yeah.
So that's the question. One question for the sector is, are those alternatives going to come back into favor? What else needs to happen for them to come back? They're offering some very attractive yields, some of them, 9-10% in some cases, inflation linked to some considerable degree. So you'd think at some point they will come back, but that may depend also on corporate activity. So what we've seen in the investment trust equity sector, we've seen a lot of consolidation. We've seen trusts merging to get bigger. We've seen trusts, as I say, winding up in some cases. So is that phase of consolidation, Simon, which your JP Morgan has been involved, is that going to continue? I should mention perhaps one other thing, that before he moved to JP Morgan, Simon was the head of investment trust research at Winterfloods for many, many years. So, despite appearances, I don't know what I'm talking about, but he does actually know what he's talking about.
You're too kind, you're too kind. So consolidation, there's been an awful lot of consolidation across the investment company space. I mean, at JP Morgan, I think we've done 6 deals, 6 consolidations in the last 3 years. There's one underway at the moment, so our global fund, JGGI, which has presented at this event in previous years, we're currently consolidating that with Henderson International Income, so HINT is merging into JGGI, and there are a number of others underway across the sector as well. So consolidation makes sense if you put 2 investment trusts together to create a larger one with cheaper costs, and it has better liquidity as well. So when you look on your Hargreaves Lansdown or AJ Bell accounts, you'll see the spread at which the larger investment trusts invariably are tighter. So the difference between the bid-offer price. So it is important. For the alternative investment companies, they are more difficult deals. It's more difficult to put these investment companies together. So we are starting to see corporate activity in this space, but compared with what I described as the plain vanilla, the long-standing investment trusts, they're more straightforward. But it's worth noting that there are some quite expensive fees and costs involved in putting 2 investment trusts together. So, £2 million is not uncommon to put 2 ordinary size investment companies together. So it's got to be right for ongoing shareholders.
We had a lot of activity in the last 12 months, and I think that will continue into this year.
Yeah.
I think almost certainly we'll see more of these deals being done. But the question I guess I had to put you, Simon, is this: are the factors that have driven consolidation, are they still there? So we've had interest rates, obviously was one of them, but we've also had these issues around liquidity in the UK stock market, and also the fact that wealth managers are consolidating themselves. They're all combining together, and the minimum amount they can invest in the kind of minimum market capitalization they can invest in, the bar has been going higher.
Yeah,
that's still the case, right?
Absolutely. Those drivers of consolidation still remain very much the case. So on the point of the wealth managers, we have seen a lot of consolidation in that side, and wealth managers have historically been big buyers of investment trusts. So names such as Rathbones, Charles Stanley, Brewin Dolphin, and you go through the list, and they need larger and larger investment trusts in order to buy them across their client portfolios. So that is very important.
And so far we haven't talked about Saba Capital. I put that in the headline because that's been very much in the news. They're a US hedge fund which bought a huge number of stakes in UK investment trusts and trying to play what we call discount arbitrage. Their purpose was to buy some of these trusts at a big discount, talk to the management, and they initially proposed taking over the running of some of these trusts. That failed. They had a kind of assault on 7 very well-known trusts. They all got rejected, what they were proposing, but they're still on shareholder registers at the moment. And the big question is, what are they going to do? What's going to happen to them?
Yeah.
Can you say something about that?
I can do, I think.
Here we are. Here's some of the trusts they've disclosed holdings in.
So the fact that we've seen an activist investor play in the investment company space is probably not surprising, frankly, given where discounts got to. So as discounts widen out, the prospect of buying an investment company for 85p in the pound and then doing something about it is quite an attractive trade. And if you go back to the noughties, which was a period when investment companies were also out of favor, then we saw activists get involved at that stage as well. And that leads to corporate activity, it might lead to liquidation, it might lead to consolidation. Where Saba was a little bit different and where they got a lot of resistance, a big pushback, was that they were trying to win or trying to take over the investment contracts, as Jonathan said. And for that, they received a resounding no, I think we can say, in the not so magnificent 7, the initial investment trust that they targeted. But as Jonathan's slide shows, they're still there, they're still on the register, and some people would argue that that is a catalyst for more corporate action to come in the next year or so.
And it certainly grabbed the attention, both it's been remarkable that actually investment trusts have featured in the newspapers, the business page of the newspapers, a lot of headlines in the last few months because of what Saba have done. it's actually put investment trusts and the discounts back in the, if you like, in the public domain, which is very helpful. But the question about them, lots of questions about them. What are they going to do now? Have they made enough money already out of what they've been doing? And if they disappear, will the discounts go back again? But if you look here, it's quite interesting. They've started building up stakes back in summer of 23, I think. And then they had this kind of late splurge at the end of last year, where they really accelerated the pace of their buying, getting up to 29% in some cases. But here you can see this is their fund they run in the US, the Saba closed-end funds, okay, which does this kind of thing both in America and here. They're not performing very well, frankly. They're so far, since a year ago, they're up around 6%. So all this money, this 1.5 billion that they put into buying investment trust stake, has not so far produced a significant return for them. And they also, being a hedge fund, they're very reliant on short-term performance. So it may be that they may have to retreat a little bit with their tail between their legs. But the real impact has been on, I think, it's fair to say, on the boards of investment trusts. The fact that investment trusts are listed companies with independent boards is a huge part of the reason why you want to own an investment trust. The quality of governance. You are getting someone who's being paid to look after your interests. Whereas in an open-ended fund, you don't get that in the same way. So boards have been reacting in all sorts of ways. Simon is busy advising the ones that he works with very closely. How would you describe how boards have reacted? And would you agree that basically the arrival of Saba has put a bit of a bomb under some boards anyway?
Yeah, I mean, look, investment trust boards, and it's worth just reflecting on that. So one of the unique features of investment trusts is that they have boards of independent directors, so non-executive directors. There are a few wandering around here today, actually, and they're not beholden to JP Morgan or Janus Henderson or Baillie Gifford. Their job is to protect shareholders. But they've been very busy over recent months and over the last year, particularly those that have had a high level of Saba holdings on their register. But they will be very aware of this, and I don't think it's any coincidence that we've seen the level of buybacks pick up across the investment trust sector. So in the first 2 months of this year, £1.8 billion of buybacks went through in the investment trust world. I mean, you go back a couple of years, you wouldn't have seen that in a whole calendar year. So that probably represents double the run rate that we saw pre the kind of Saba crisis.
And the good news of all this board behavior, this reaction to what Saba and others have done, plus the big discounts themselves, has had some benefits for shareholders. The buybacks, if you buy back your shares at a big discount, that is accretive to NAV. A lot of boards have renegotiated fees lower for investors, which is a big factor in long-term performance, and generally taking shareholders more seriously. So they've been introducing new devices like continuation votes, tenders, and so on. But there's no one template of how boards have responded, right? We've seen all sorts of different proposals. In the last couple of weeks, we've seen one announcement from Montanaro European, for example, which is doing one thing, and we've heard announcements from a number of others which are looking for other ways to try and preserve their independence, if you like, and the future for the shareholders who survive. Is that a fair comment?
Yes, I think that's very fair. I think that, look, there's no one size fits all in terms of how to tackle your discount. And I think probably the starting point...
Sorry, I'm not doing anything of interest.
Probably the starting point is you've got to understand why you're trading on a discount. So it might be that your asset class is out of favor. It might be that your performance is frankly not very good. It might be that actually you've got, some undesirables on the register. So it's very important to be aware of this before you tackle the discount issue. But it's a tricky one because essentially investment trust companies should, in theory, be captive forms of capital. One of the great advantages of investment trust, it allows the investors or the portfolio manager to take longer term investment decisions. And if you have to start running liquidity, i.e. buying back and all the rest of it, then that becomes a little bit more difficult. You might as well just be running an open-ended fund.
Exactly. So I guess the final question really we can address here in this short period of time is this a good time to be looking at investment trust as a potential way to achieve some of your investment objectives? Whether that is income, whether I mentioned already some significant yields you can get, which are well covered in certain parts of the market, or whether that's growth, or whether it's just defensiveness, trying to protect yourself against any kind of storm that may follow the Trump administration's rather remarkable policies around the world, which is very destabilizing. the great beauty of the investment trust sector is it offers opportunities in all those areas. Simon obviously isn't allowed to recommend anything because of, by virtue of the rules. I'm a little constrained as well because I have a publication, a newsletter that mentions these things. I'm not allowed to plug things blatantly. But what I would say is that some of these, the investment trusts that have done well, every year in the investment trust handbook I put in a table of the best performers over 10, 20 and 30 years. And it is remarkable how some of the names keep recurring over every period. These are well-established, well-managed, large liquid investment trusts that will have done, and I think will continue to offer opportunities. And you can now buy some of them, not all of them, some of them still at a discount. So you are getting something like 90p in the pound in some cases. You need to track what those discounts are doing, and then you'll judge whether, if it is a long-term holding that you want to have, it's a good time to buy or not, or whether you actually want to take a bit more risk by looking at some of the bigger discounts that are out there. I put up this slide just because these are a number of trusts that basically most investment trust investors would put in the kind of premium class. They've been around for a long time. They've got good long-term performance, which is what you want, and and some of them are still on a discount. And since this time last year, well, some of them have done quite well. None of them have matched the US, or very few of them have matched the US market. We saw a few at the very beginning that had done, but basically these things are still worth looking at, even though they may not have performed so well over the last period. So we got things like, Fidelity European is well established. It was managed by Anthony Bolton originally, done very well. Europe's done well this year. That's still attractive, I think, where it's rated at. Things like Capital Gearing, which are defensive trusts designed to dampen down the volatility of your portfolio. They're all-weather trusts, what we call all-weather trusts, absolute return vehicles. They are designed to go on steadily grinding out a small percentage return every year for whatever's happening to the market overall. So you can dampen your volatility by buying those kind of trusts. And some of these, Bluefield Solar, for example, that's one of the ones which is trading has a 9 or 10% discount and has got inflation, 60% of its revenues are inflation proof and so on, going out for 20-year visibility. At some point, they perform very badly. At some point, they will come good. So Simon, just finally, looking back over your career in investment trust, which goes back
not as
a long way, how would you characterize where we are in the kind of grand scheme of things, the cycle of investment trusts, which has been very evident over many years?
Yeah, it's a good question, and I've been involved 25 years or so in investment companies, and during that time, I think the sector's faced at least 3 existential crises when people wondered whether investment companies would survive, whether the 150-year history would come to an end. In each instance, or so far, that hasn't happened. And on those previous 2 crises, that's proven to be a great buying opportunity for investment companies. So obviously nothing is guaranteed in life, but it is worth looking when things are a little bit out of favor, and investment companies have certainly benefited from that historically.
Absolutely. So that brings us to the end of our allotted time, I'm afraid. The time does rush by at these sessions. We've got time for a couple of questions. If anybody wants to ask something, fine. There's a microphone just coming, sir. So let's hear what you'd like to hear from us.
I thought it was interesting that you're probably the first person that's actually said something positive about Saba, when actually the people in this room have a lot to thank Saba for, to stir things up, to make the companies that we invest in take action to address long-standing issues. And I'm glad that you're the first person to be saying that, because there's a lot of people that don't.
Indeed. Well, one of the points that Bose Weinstein, who I have talked to on the podcast, one of the points he made is that there is a sort of ecosystem in London. There are a lot of interested parties in the Future Investment Trust. There's no doubt about that. And of course, I'm an independent observer, so I can say that. I think they have done some good. They have put a bomb under a lot of boards. I think the tactics they adopted were very ill-advised, but they have put them back on the front pages of the business pages anyway, of the newspapers. And they have, I think, they have triggered reaction from investors, and they've highlighted they put the spotlight on this issue about discounts, and I think some boards have been too complacent about that. There's no question about it, and that's why some of them have gone out of business, and why others will continue to do so. So I think that's a very fair point. We may not like the guy or the way his tactics, but if you look back to Scottish Mortgage, I know, which is a very popular held trust, they had an activist called Elliott Investors on their share register, and they actually bought back a big chunk of shares from them, and they haven't looked back since. So yes, there is a place for activist investors. There are some more out there, but they don't like to be in the headlines like others, and that's true. Can you say anything about the kind of activist investors that are out there who aren't Saba? If I put it that way?
Yeah, I mean, look, there are a number of institutional investors in the investment company space. They all have their different strategies. Some are just value players. Some just like buying on a wide discount, 15%, happy to sell on a 10, and that's how they generate their outperformance. But I think while discounts remain quite so wide as they are at the moment, we're going to see more of these type of investors.
Yeah. Any other questions?
Hello, thanks for a very interesting presentation. A quick question. On the bottom two on your screen there, you got the renewables, which are sort of not performing well over the last year or so. Do you think, when do you think they will change? What will trigger the change in their performance and their valuation?
Well, what has changed in their performance? Well, it is true that NAVs have gone down a little bit over the past 12 months. The power prices have been a bit lower than people were expecting, and some of the wind hasn't blown quite as much as it should have done, and so on. And there have been a lot of issues around connectivity to the grid and so on. So they haven't performed that well in NAV terms, and there is a question because the way they're valued is based on basically on a model. They make lots of assumptions about future prices and future interest rates and so on, and that's always open to some interpretation. I mean, it's a guess to some extent, and so you could argue, well, maybe the NAVs aren't as good as they are reported to be, not through deliberate malpractice, just through it's a very complicated thing to do to come up with an NAV for a complex, large investment trust, renewable trust. But Simon, you were an analyst. How did you deal with that problem?
Jonathan's absolutely right. They are quite complicated investment companies to break down at the end of the day. How do you value these things? What are they worth? And, quite literally, there are a lot of moving parts. So that means when things do go wrong, then that can hit the NAVs. But it'd be wrong to say that the performance of the kind of renewable energy names have been because of NAV declines. That's been true, but it's more about the share price and the derating. I mean, these things have gone from 10% premiums to 30% discounts, and that's where the pain has really been suffered.
They have appeared to stabilize a little bit in the last few things. Yeah. Well, eventually, the law of markets will apply. If they can't get rid of those discounts, they will become vulnerable to being bought out by, I've met someone from Blackstone today. Blackstone is a big US firm. They took out Hypnosis. They will be having a look at infrastructure and renewables as well when the time is right, when they judge that the time is right. If they think the assets are wrongly priced or they may have a chance to come in and take things out. So that's your kind of backstop. The second backstop is that the discounts are already very, very wide. And so if they don't improve, the boards will be under enormous pressure from the shareholders to do more about it, whether that's reducing debt, selling assets, or ultimately just winding the thing up if they think they can get a better deal that way. So you do get this backstop from the wide discounts, but there's no guarantee how quickly that can reverse. In the case of equity trusts, it's a slightly different picture because there's much more that the boards can do in the short term to turn things around. I think that's fair.
Yeah, I think that's fair. So if you look at the JP Morgan stable as a case in point, we're effectively long-only equity trusts. Our average discount's probably about 8% or so at the moment. So nothing compared with some of those alternative names.
Okay, so we have slightly overrun our time, I'm afraid. I would like to end by urging you to listen to the podcast if you have a chance. It comes out every week. We're now doing normally two episodes a week. Every week we have a record number of listeners, and we're coming up to our 5th anniversary next week. So please do listen if you're interested in investment trusts. And there are some copies of the Investment Trust Handbook, which retails at £30, but is available to you today for
Gratis.
Nothing. So do feel free to have one.
Thank you
and
very much.
Thank you very much
Thank
for your
you.
attention.